Imagine a business that doesn't care if the market is going up or down. In fact, it prefers when the market is panicky, uncertain, and volatile. While investors bite their nails trying to guess interest rates, this company is charging the entrance fee for everyone to place their bets in hedges. I'm not talking about a bank or a hedge fund. I'm talking about the house. And as the saying goes, the house always wins. Today, we're going to dive deep into the investment case of CME Group, ticker CME, the world's largest financial derivatives exchange. In this video, we're going to break down the latest report on the company. We'll understand its business strategy, the economic moat concept that protects it, the battle between bulls and bears, and why their dividend policy is one of the most interesting on the American Stock Exchange. Get ready, grab your coffee, because this is a complete lesson on the infrastructure of the financial market. Strategy and business outlook. Let's start with the heart of the business, the strategy and current moment. CME Group is, essentially, a transactional company. It makes money from volume. The more futures and options contracts are traded, the more revenue comes in, and the 2024 scenario was a field day for them. The key word here is volatility. Until 2023, CME had a problem. Interest rates were very low and stable. Think about it. If you know interest rates will stay at zero, why would you spend money hedging or speculating on rate changes? It doesn't make sense, right? This held back CME's revenue, as interest rate contracts are the company's main driver. But the game changed. Market complacency was replaced by uncertainty. The doubt about whether interest rates would go up, down, or stay the same shifted trading volume from a cyclically low level to a cyclically high level. This accelerated growth. However, an important warning. We believe this extreme tailwind has passed. The expectation is that, as conditions normalize, the explosive growth of interest rate contracts will slow down. Another pillar of the current strategy is retail. In 2020 and 2021, we saw an influx of smaller investors into the stock market. CME was smart and capitalized on this with products like micro futures, micro E-mini S&P 500. While the absurd growth of that time shouldn't return, CME created a new permanent customer base. Small investors now use futures, and this is a revenue stream that's here to stay. Strategy summary: CME dominates commodity, energy, and interest rate contracts. It profits from the secular need for hedging. It launches new products, like SOFR and micro E-mini futures, to generate incremental growth. But it's not all sunshine and rainbows. There's a new threat on the horizon. FMX, a new exchange that launched interest rate futures in September 2024. We'll discuss whether this is dangerous or not later, but I'll tell you now, FMX's initial volume has been low. The economic moat. Now, we get to the most important part for the long-term investor, the economic advantage. CME has a strong competitive advantage rating. Why? Basically, it's a monopoly in several areas. Over 95% of US interest rate futures contracts are traded there. It has an exclusive license for S&P 500, Russell 2000, and NASDAQ futures. It dominates WTI oil. CME's great strength lies in the network effect. In the futures market, liquidity attracts liquidity. If you're a large bank and you want to hedge billions of dollars, you need to go where everyone else is, to ensure you can buy or sell without distorting the price. There have been attempts to take down CME. NYSE LIF and ELX tried to enter the interest rate market with cheaper fees. Do you know what happened? They failed. Why? Because the transaction cost, the exchange fee, is irrelevant compared to the implicit cost of liquidity. The minimum tick, the smallest price change of a treasury contract, is 15.62. The exchange fee costs cents, 30 to 70 cents. If you go to a competing exchange and pay a lower fee, but the price execution is one tick worse due to lack of liquidity, you've lost $15 to save 50 cents. It doesn't add up. This gives CME absurd pricing power. They maintain operating margins around 60%. Furthermore, CME's structure is vertically integrated. It is both the exchange and the clearinghouse. If you buy a contract on CME, you cannot settle it on another exchange. Liquidity is trapped inside. This also creates collateral efficiency. If you are long S&P 500 and short Nasdaq on the same exchange, CME offsets the risks and requires you to deposit less collateral. If you operated on different exchanges, you would have to deposit double the collateral. Nobody wants to do that. Finally, we have the intangibles. CME owns 27% of S&P Dow Jones indices. This ensures that no one else can launch the official S&P 500 futures contract. It's an almost insurmountable moat. Financial strength and capital allocation. Let's talk about money in the pocket. Is CME a financial fortress? The short answer is yes. At the end of December 2024, the numbers were: shareholder equity, $26.5 billion, debt, $3.3 billion, cash, almost $2.9 billion. They operate conservatively, with a goal of keeping a lot of cash available. But what about the risk? Since it guarantees transactions, if a large bank goes bankrupt, does CME have to pay the bill? Yes, but with limits. The structure is cascaded. If someone defaults, first the defaulter's collateral is used. Then, a guarantee fund paid by members. CME only contributes its own capital up to a limit of $250 million. The total guarantee fund is about $22 billion, reference data from 2020. In other words, CME's balance sheet is very well protected against systemic credit risk. Now, what interests many of you? Dividends. CME has an exemplary capital allocation rating. Their policy is unique. They pay a regular quarterly dividend, predictable, and once a year they pay a variable special dividend. The idea is, we're going to return almost all free cash flow to shareholders. If it was a good year, lots of volatility, the special dividend is fat. If the year was weak, the special dividend decreases. This prevents the company from committing to payments it cannot sustain. About acquisitions, M&A. They bought CBOT and NYMEX back then, 2007-2008. Did they pay too much? Maybe. But strategically, it was what guaranteed today's monopoly. More recently, they bought NEX in 2018 for $5.5 billion. Strategically, it made sense. Fixed income and collateral optimization. But the financial results of this division have been disappointing, with stagnant revenues. Bulls versus bears, the debate. Every investment has two sides. Let's lay out the arguments. What do the bulls, optimists, say? 1. Diversification. If interest rates fall, maybe stocks go up. If stocks are stagnant, maybe commodities explode. CME has products for everything. Interest rates, stocks, metals, currencies. The weakness of one is offset by the strength of another. 2. Innovation. They've proven they know how to create new products like micro-futures and SOFR, which generate extra volume. 3. Friend of chaos. In a world increasingly uncertain geopolitically and economically, volatility is guaranteed. And volatility means profit for CME. What do the bears, pessimists, say? 1. Transactional model. Unlike software companies that earn recurring subscriptions, SaaS, CME needs people to trade today. If the market gets too calm, revenue falls. 2. Peak volatility. We're coming out of a period of exceptionally high volatility. A return to normal might look like a recession for CME's profits. 3. NEX acquisition. The fixed income and spot FX part they bought from NEX isn't growing. This could be a dead weight or a sign of poor execution. Risks and uncertainties. No investment is risk-free. Morningstar's uncertainty rating for CME is low, but there are points to consider. 1. FMX competition. We've already mentioned it, but it's worth repeating. FMX is the new competitor backed by large banks. Although CME's moat is huge, any success FMX has in stealing interest rate futures liquidity would be bad news. For now, CME is safe due to its network effects. 2. Dependence on volume. Remember, CME doesn't care about market direction, but it suffers from market apathy. Low volatility equals low profit. 3. ESG risk. Oil. CME trades energy and oil contracts. If, in the very long term, the world stops using oil due to environmental concerns, this part of the revenue, about 13% in 2024 combined with gas, could disappear. It's a distant risk, but it exists. 4. Regulation. As a critical infrastructure of the financial system, any regulatory changes in the United States could impact margins or require more capital. Conclusion and verdict. So what's the verdict on CME Group? We are looking at a company with one of the widest economic moats in the world. It's hard to imagine the global financial system functioning without CME's products. It's a cash-generating machine, conservatively managed, and prioritizes returning money to shareholders through smart variable dividends. The investment thesis here is clear. You're buying the house of the financial casino. You benefit from the fear and greed of others, protected by almost insurmountable barriers to entry. The main risks are the normalization of volatility, the market becoming calm, and, to a lesser extent, the new competition from FMX. For investors seeking quality, protection against inflation and volatility, and an interesting dividend stream, CME is an asset that deserves careful study. If you enjoyed this analysis, don't forget to hit the like button. Comment below, do you prefer to invest in companies that produce things, or in the exchanges that trade those companies? Thanks for watching and happy investing.